time to get going with our class again. And while we're settling down to our desks again, I did have a question come in from one of our attendees named John. He asks, should my asset be up and running and in use before I can claim the depreciation deduction? Well, one of the things you'll notice when I'm teaching the class is I may say, well, this is the date he bought it. But when you get into completing a Form 4562 or a depreciation schedule, what the schedule asks you is what was the date placed in service? And for me, well, placed in service would mean that if it was a computer, you took it out of the box, you put it on your desk, you turned it on, and you did something related to your business on it. That would mean it was in service on that day at that point in time. And for depreciation, that's an important and significant event, that it was placed in service on that day. Now, is the IRS going to come along and notice that the computer didn't get turned on until January 2nd after you took January 1st off and December 31st you weren't really working either? Odds are probably not. They're probably going to rely on the receipt that you had showing the date that it was bought. But technically, the placed in service is what you are interested in and not the date that you paid for it, but rather the date that you received it and took it out of the box and started using it. And when we get into a business that's just starting up, say opening for business for the first time, the placed in service date for assets are going to be the date that you're able to start using them in your business. And that may not be the date they bought or even the date that you first started using them, because you can't begin depreciation until your business is up and running, at least in that respect. It would be part of your startup. All right, so the next topic of the day is Section 179. And when we are in the world of depreciation and we say, hey, I'm going to expense an item, what we mean is I'm going to claim a Section 179 deduction for that item. To claim a Section 179 expense, all of the following must be true. The property must be used more than 50% in a trade or business. The property must be acquired for use in your trade or business. The property must be purchased and cannot be acquired from a related person or group. And you must elect to claim a Section 179 expense in the first year that the property is placed in service. So property acquired for business use, what does that mean? To qualify for the Section 179 deduction, your property must have been acquired for use in your trade or business. Property you acquire only for the production of income, such as investment property, rental property, if renting property is not your trade or business, and property that produces royalties, does not qualify for the Section 179 deduction. Partial business use. When you use property for both business and non-business purposes, you can elect the Section 179 deduction only if you use the property more than 50% for business in the year you place it in service. If you use the property more than 50% for business, multiply the cost of the property by the percentage of business use. Use the resulting business cost to figure your Section 179 deduction. And here we have an example, figuring the Section 179 deduction for partial business use property. Mary Oak bought and placed in service an item of Section 179 property costing $11,000. She used the property 80% for her business and 20% for personal purposes. The business part of the cost of the property is $8,800. That's 80% times $11,000. If Mary elects to expense the item, her maximum Section 179 deduction for the item is limited to $8,800. The property that you claim the Section 179 deduction on must have been acquired by purchase. To qualify for the Section 179 deduction, your property must have been acquired by purchase. For example, property acquired by gift or inheritance does not qualify for the deduction. Property is not considered acquired by purchase in the following situations. It is acquired by one member of a controlled group from another member of the same group. Its basis is determined either in whole or in part by its adjusted basis in the hands of the person from whom it was acquired. It's essentially the gift rules. And under stepped-up basis rules for property acquired from a decedent. Also, if it is acquired from a related person, you cannot claim the Section 179 deduction. Now, certain property is not eligible for the Section 179 deduction, and let's take a look at what that includes. Even if all of the other requirements for expensing are met, you cannot elect the Section 179 deduction for the following property. Certain property that you lease to others if you are a non-corporate lessor. Certain property used predominantly to furnish lodging or in connection with the furnishing of lodging. Air conditioning or heating units. Property used predominantly outside of the United States, except property described in Section 168. Property used by certain tax-exempt organizations, except property used in connection with the production of income, subject to the tax on unrelated trade or business income. If you're in the nonprofit world, most nonprofit organizations seek tax-exempt status so that they don't have to pay tax on their income. But if the tax-exempt organization, say, runs a retail store where it sells, I don't know, birdseed, let's say you're the Audubon Society. The Audubon Society is a nonprofit, but it might run a retail bird shop where you can go in there and buy yard supplies and bird supplies and so forth. Well, that type of situation would be a for-profit activity engaged in by the nonprofit organization. And so it actually does have to file a return, but it can't claim a Section 179 deduction. Property used by governmental units or foreign persons or entities except property used under a lease with a term of less than 6 months. Land and land improvements, including swimming pools, paved parking areas, wharves, docks, bridges, and fences, and finally, properly used for lodging. Now, the property used for lodging, I've learned the hard way several years ago what that really meant. I wasn't remembering the rule, thinking of the rule at all, and I was doing a tax return for a business that purchased a travel trailer for traveling out of town and working on job sites. And I said, oh, well, that's 7-year property. We'll claim a Section 179 deduction on that. And of all things, he was selected for audit. And that's when I learned what lodging really means. So even though the travel trailer is not something that I thought of, the IRS certainly does deem that to be an asset that is used for lodging and therefore not eligible for the deduction. It wasn't the end of the world, but we did have to pay a little bit of tax. And then, of course, later on, he was able to recover that through depreciation in other ways anyway. But it's just that for that 1 year, I made a boo-boo. Leased property. However, generally, you cannot claim a Section 179 deduction based on the cost of property you lease to someone else. This rule does not apply to corporations. However, you can claim a Section 179 deduction for the cost of the following property. Property you manufacture or produce and then lease to others. Property you purchase and lease to others if both of the following tests are met. The term of the lease, including options to renew, is less than 50% of the property's class life. And B, for the first 12 months after the property is transferred to the lessee, the total business deductions you are allowed on the property, other than rents and reimbursed amounts, are more than 15% of the rental income from the property. Property used for lodging, again, cannot be expensed. Generally, you cannot claim a Section 179 deduction for property used predominantly to furnish lodging or in connection with the furnishing of lodging. However, this does not apply to the following types of property. Non-lodging commercial facilities that are available to those not using the lodging facilities on the same basis as they are available to those using the lodging facilities. If anything sounds confusing, that's it. It's like, what the heck do they mean by that? I think they are meaning something similar to the next bullet, which is, oh, it's a hotel. Property used by a hotel or motel in connection with the trade or business of furnishing lodging, where the predominant portion of the accommodations is used by transients. So let's compare these two concepts. You have a rental property. Well, once you sign a lease on that rental property, it's not available for anyone else to spend the night in. The tenants have the right to that property, and they can have their friends over, but you as the landlord have no longer got rights to the use of that property because you've rented it out. Well, with a hotel, obviously there's not really a lease being signed. There's a person who's booked the room for the night or 2 nights, and they're going to move on. And therefore, the difference between that is that if you have a residential rental house, you will not be allowed to claim a Section 179 deduction on assets that you place in service in that rental. But if you are running a hotel and you purchase assets for use in that hotel and they are used by people who are spending the night in your hotel, those would still be eligible for the Section 179 deduction. Also eligible for the Section 179 deduction is any certified historic structure to the extent its basis is due to qualified rehabilitation expenditures and any energy property. So what is energy property? Energy property is property that meets the following requirements. It is one of the following types of property. Equipment that uses solar energy to generate electricity to heat or cool a structure, to provide hot water for use in a structure, or to provide solar process heat, except for equipment that is used to generate heat for a swimming pool. And equipment placed in service after December 31, 2005 and before January 1, 2017 that uses solar energy to illuminate the inside of a structure using fiber optic distributed light, sunlight. That sounds kind of cool. Equipment used to purchase, distribute, or use energy derived from a geothermal deposit. For electricity generated by a geothermal power, this includes equipment up to but not including the electrical transmission stage, and qualified fuel cell property or qualified microturbine property placed in service after 2005 and before 2017. It also includes the construction, reconstruction, or erection of the property that must be completed by you. For property you acquire, the original use of the property must begin with you, and the property must meet the performance and quality standards, if any, prescribed by income tax regulations in effect at the time you get to that property. So to settle it all down and summarize what you can and cannot expense under Section 179, I've got a table here. And on the left column it shows what you can expense, and on the right column it shows what cannot be expensed. Let's start with things that you can expense. They include grocery store counters, refrigerators, transportation equipment, office equipment, printing presses, signs, livestock, single-purpose agricultural structures and single-purpose horticultural structures, petroleum storage facilities except buildings, and certain leasehold restaurant improvements. You cannot expense swimming pools, paved parking areas, bridges, fences, docks, buildings, heating and air conditioning units, permanent structures, property used for lodging, property you lease from others, and most property that you lease from others. It's probably supposed to be most property that you lease to others. I think that's something that needs to be fixed. Trade-in of other property. If you buy qualifying property with cash and trade in, its cost for purposes of the Section 179 deduction includes only cash you paid. Example, Section 179 deduction limited to cash paid in a like-kind exchange. Well, today's class is not about a like-kind exchange. We do cover like-kind exchanges a tad bit next week in sale of assets, but later on in August I actually have a full hour, maybe a little bit over an hour, where we do a lot of background and education on how you do a like-kind exchange, the rules for that. But I'm going to touch on them a little bit here just for the purposes of this illustration, because it's important to understand how much Section 179 deduction is possible or allowed to be claimed in the event you do engage in a like-kind exchange. Our character in this story is a business called Equine Escape, which is a horse boarding facility. And this horse boarding facility called Equine Escape traded a horse trailer with an adjusted basis of $5,000 for a new trailer costing $15,000. Equine Escape received an $8,000 trade-in allowance for the old trailer and paid $7,000 in cash for the new trailer. The basis in the new trailer will therefore be $12,000. $5,000 is the remaining basis in the old trailer plus the $7,000 of cash paid for the new trailer. Equine Escape also purchased a used pickup truck with an adjusted basis of $14,000 for a new truck costing $25,000. They received a $13,000 trade-in allowance on the used truck and paid $12,000 in cash for the new truck. The basis in the new truck is $26,000, which is totaled by taking the $14,000 of remaining basis in the old truck and adding to that the cash that they paid for the new truck. A Section 179 deduction will be allowed only for the portion of the cost of the new property that was paid for in cash. Therefore, Equine Escape's qualifying cost for Section 179 is $19,000. The $7,000 of cash paid for the trailer, and the $12,000 of cash paid for the new truck. So on Section 179, on the Form 4562, when it asks for the cost of assets placed in service during the year under Section 179 or eligible for the Section 179 deduction, the answer is $19,000. And what will happen for the depreciation schedule on Equine Escape is the remaining existing basis of both the trailer and the pickup truck will continue on the depreciation schedule. You won't mark those as assets distributed or sold. They continue to exist on the depreciation schedule. You will then enter new depreciation entries for the additional cost paid for the traded-in property. And so ultimately you trade out two pieces of property. The depreciation items on the depreciation schedule for those two traded out items are not taken away. They remain on the depreciation schedule, and you keep depreciating that remaining basis in those assets. And you will then enter two new lines on the depreciation schedule for the new assets being placed in service, the trailer and the truck. How do I make a Section 179 election? Well, you make it by completing Part 1 of Form 4562. Claiming the deduction. If you place listed property in service during the year, you will make the election on Part 5 of 4562 rather than in Part 1. So there's two possible places you will make the election or tell the IRS that you are claiming the deduction. One is in Part 1, but if you place listed property in service, you make the election in Part 5 and then carry the deduction to Part 1. So here is Part 5 of Form 4562. For listed property, you need to complete Section A anytime you have listed property placed in service during the year. There are limits on the amount of Section 179 deduction that you can claim. For most property, the maximum Section 179 deduction you can claim in 2012 is $500,000. However, the following property has different limits. The maximum deduction you are allowed to claim for a sport utility vehicle is $25,000. The maximum deduction allowed for qualified real property is limited to $250,000. For qualified enterprise zone property, the maximum deduction is increased by $35,000 to $535,000, and for qualified disaster assistance property, the maximum deduction is increased by $100,000 to $600,000. No Section 179 deduction allowed. You may not be allowed to claim the full $500,000 deduction if the total cost of all qualifying 179 property placed in service during the year is greater than $2 million, or your cost of qualified property placed in service during the year is greater than your taxable income from active conduct of a trade or business. Prior to figuring the Section 179 deduction, self-employment tax deduction, or the NOL deduction. And I have a little asterisk here that says, income from active conduct of a trade or business does include income from wages. So we'll do some illustrations here to show you what we mean by active conduct of a trade or business and how the limits also can apply and reduce your deduction. Here we have a situation where the Section 179 deduction is limited. During the year, Ann Gable purchased and placed in service $2.2 million of qualified Section 179 property. Her business profit for the year is $300,000. Her Section 179 deduction is limited to $300,000 and is calculated as follows. So we can see here that we have a built-in limit on line 1. This is not a number that I enter in. It's actually a number that the IRS puts most of the time on line 1. Your software will probably default to $500,000, but there are certain situations where the limit could be higher. If it's disaster property or if it's enterprise zone property, it could be $535 for enterprise zone and up to $600 for disaster area property. But most of the time, $500 is the number you'll see there. Then it says, enter the total cost of all of the Section 179 property you placed in service during the year, and for Ann Gable, that was $2.2 million. And then we calculate a reduction in the limitation, and that is because the limit that we're allowed to spend on Section 179 property or assets for the year is $2 million, we're going to have to subtract $2 million from 2.2, and we get $200,000. We then subtract $200,000 from $500,000, and we're left with the maximum deduction that Ann Gable is allowed to claim. On line 6, we provide a description of the asset being depreciated. We're saying it's a manufacturing line. The cost is $2.2 million. Her elected cost is $300,000, and that's the amount she can claim. Her business profit is at least $300,000. In fact, it's the same as the Section 179 deduction, so she's not limited by that. Now, with regard to these limits, the $500,000 limit and the $2 million limit, married persons must share that limit. For purposes of calculating the maximum deduction and the maximum dollar limits, a married couple is treated as a single taxpayer. It does not matter if they file jointly or separately, they must share the allowable limits. But they could have one person claim all of the limit and the other claim none, or they could have some unequal division of the limit between them, as long as they don't exceed the limit when you combine them. Partnerships and partners limit. The Section 179 deduction limit applies both to the partnership and to each partner. The partnership determines its Section 179 deduction subject to the limits, and then it allocates the deduction amongst its partners. And they, in turn, have to figure how much they are allowed to claim. S corporation and shareholders limits. Generally, the rules that apply to a partnership and its partners also apply to an S corporation and its shareholders. The deduction limits apply to the S corporation and to each shareholder in it. The S corporation allocates its deduction to the shareholders, who then take the deduction on their returns subject to the limits. And one of the things you'll notice is when you prepare Schedule C, maybe you haven't noticed it till now, but you'll probably look for it after today's class. If you look at Schedule C, there's a line on Schedule C where you enter your Section 179 deduction as part of the depreciation deduction. There's a line on Schedule C where you enter depreciation. And the instructions for Schedule C tell you to include the Section 179 deduction as well as any other depreciation you claimed for that business. But if you move over to an 1120S, which is filed by S corporations, or a 1065 that's filed by partnerships, There is a line on those forms as well for depreciation, but the instructions for those lines tell you not to include any Section 179 deduction. So partnerships and S corporations are allowed to claim deductions for depreciation, but they are not allowed to claim deductions for 179. Instead, the Section 179 deduction carries over to the Schedule K-1s, and it flows through to the partners. So the partners will see that they have a gross income amount on line 1, and then underneath that, on another line of the Schedule K-1, it will show what their Section 179 deduction is. And you deduct the Section 179 deduction from the income and report the difference as income, provided the client qualifies for the deduction, which is possible that they wouldn't. You know, they have limits on the individual side as well as the limits coming at the partnership level. Business income limit. The total cost you can deduct each year after you apply the dollar limit is limited by the total taxable income from the active conduct of any trade or business during the year. Carry forward. Any cost that you are not able to deduct in 1 year under Section 179 because of the income limit can be carried forward to the next year. Special rules apply to a 2012 deduction of qualified Section 179 real property that is disallowed because of the business income limit. So here is taxable income, and what do we mean by that? For purposes of determining net income from all trades or businesses, your taxable income or loss from a trade or business includes Section 1231 gains or losses. Well, we'll learn what those are about next week in our course Sale of Assets. Also, interest from working capital of your trade or business. Wages, salaries, tips, or other pay that you earned as an employee. In addition, figure taxable income without regard to any of the following deductions for the year: the Section 179 deduction, the self-employment tax deduction, any net operating loss carryback or carry forward, and any unreimbursed employee business expense. So here's an illustration of how these limits work. Morgan Chevelle operates an equine transportation business. During the year, his business income totaled $200,000, and he purchased and placed in service a tractor and a horse trailer costing $400,000. The tractor trailer was the only property he placed in service for the year, and he had no other business income for the year. Morgan's allowable Section 179 deduction and his carry forward are shown next. So in this case, on line 1, we still start with that same $500,000 limit. This time, the total cost of the assets he's placed in service is $400,000. That's less than $2 million. So his line 5 is equal to line 1. He does not have to reduce the maximum allowable deduction. He's allowed the maximum deduction. However, he has to now go over and see if there's any other limits in effect. And we go over and we see that his cost in the tractor and trailer and his elected cost for the deduction are both $400,000. But when we get down to line 11, it asks what the business income limitation is. And I've told you that his business income is $200,000. He cannot claim more than $200,000 as a deduction. So he will claim a Section 179 deduction of $179,000, and then he will have a $200,000 carry forward to next year. And there is a line for that. Yeah, line 10, if you can see right here, carryover of disallowed deduction from 2011. So next year, Morgan Chevelle will take this $200,000 number and plunk it on line 10 of his 2013 4562. Sale or disposition of property with a Section 179 carry forward. If you sell or otherwise dispose of property before you can finish claiming a carry forward amount, you must add the unused carry forward back into your basis to the property. Recapture of Section 179 deduction. If you sell property for which you claim a Section 179 deduction, you may have to recapture part or all of the allowable deduction. You will have to recapture your deduction if you dispose of your property before its maker's useful life has lapsed, or your business use of the property drops to 50% or less. This recapture and how to figure it is also covered in our course Sale of Assets. What we're looking at today is the fact that if you do place an asset in service and claim a Section 179 deduction for that asset, and then in a later year you either sell that asset or you stop using the asset for your business, that you're going to have to recapture some of the Section 179 deduction that you claimed. And here is an example. You purchased a computer for $2,000 in 2011 and you used it 100% in your business. You made a Section 179 election on your 2011 return for the full $2,000 cost of the computer. In 2012, you purchased a new computer and gave the old computer to your children to play computer games on. Since you claimed a Section 179 deduction on the old computer, you must recapture the excess depreciation on your 2012 return. And again, how you go about doing that would be utilizing Form 4797, which is the subject of next week's class. Listed property, certain depreciable property is more closely scrutinized by the IRS because it can easily be used for personal as well as business purposes. Such property is called listed property. It's on a list. And depreciation rules governing the listed property are more restrictive than for other kinds of property. Following are examples of what listed property includes. Any passenger automobile that weighs 6,000 pounds or less, with some exceptions for specialized truck and utility service vehicles. Any other property used for transportation, including airplanes, boats, motorhomes, unless it is an accepted vehicle. Property generally used for entertainment, recreation, or amusement, including photographic, phonographic, communication, and video recording equipment. Computers and related peripheral equipment, unless they are owned by a business owner and used only at a regular business establishment. A home office that is used regularly and exclusively for business use is a regular business establishment. Certain property has been eliminated from the definition of listed property. Beginning with 2010, cell phones are no longer considered to be listed property. There's quite a headache for quite some time. The IRS is being forced to aggressively track personal use of cell phones when it's really difficult to even separate the phone from the person. They're on the phone for business, they're on the phone for personal. Tracking those differences is just nightmarishly complicated. It can be done, but at any rate, the limits that were placed on cell phones under Section 179 restrictions and the listed property restrictions have been lifted. And so it's no longer considered to be listed property. Now, if you want to claim a Section 179 deduction, you have to have a predominant business use test that you passed. You can't just claim Section 179 deduction on any property. You have to be able to show that the property is predominantly used for business. You can claim a Section 179 deduction only for property that is predominantly used for business, and predominant means more than half, more than 50%. If you used it exactly 50%, that is not more than half, and it is not predominant. So if you have a client that says to you, well, I used my computer about 50% for business. Well, the question is, did you use it 50% for business or more than 50% for business? And if they say 50%, well, then it means that they're not eligible for a Section 179 deduction. It's listed property, they can't claim it. You cannot claim a Section 179 deduction for listed property that is 50% or less business use. Further, if you previously claimed a Section 179 deduction on listed property and in a subsequent year business use falls to 50% or less business use, then you may have to recover part of the deduction claimed under Section 179. How to report listed property. Claim depreciation and deductions for listed property in Part 5 of Section A of Form 4562. Each year you continue to use an asset in your business that is listed property, you must provide information about its cost and business use in this part of the form. Most assets are reported on Form 4562 for the year they are placed in service only. However, listed property must be reported on Form 4562 for every year that it remains in business use. So here we have the Part 5 showing listed property information. You can even read on here what is listed property: automobiles, certain other vehicles, certain computers, and property used for entertainment, recreation, or amusement. And then it asks you to enter similar information to what you see on Part 3 on the front of the form, where you enter the type of asset, the date placed in service, the cost or other basis, the recovery period. But in this case, it also has a column for entering the Section 179 cost. Now, one of the most common types of listed property we ever see staring us in the face is the passenger automobile, so we're going to talk about those now. The amount of depreciation and Section 179 deduction that you are allowed to claim on a passenger automobile is limited. Not only do you have to meet the rules and tests for listed property, because most automobiles are considered to be listed, you also have to worry about the limits on automobiles above and beyond just being qualified, whether or not you can do a Section 179. A passenger automobile is any four-wheeled vehicle made primarily for use on public streets, roads, and highways, and rated at 6,000 pounds or less. The following are not considered to be passenger automobiles: ambulance or hearse used directly in a trade or business, a vehicle for hire used to transport people, a truck or van that is a qualified non-personal use vehicle. All right, then, what is a qualified non-personal use vehicle then? A qualified non-personal use vehicle is a vehicle that by its nature is not likely to be used more than a minimal amount for personal purposes. Examples of non-personal use vehicles are described in Publication 946 on page 56, and they include things like clearly marked police and fire vehicles, Also, unmarked vehicles used by law enforcement officers if the use is officially authorized. Ambulances used as such and hearses used as such. Any vehicle with a loaded gross vehicle weight of over 14,000 pounds that is designed to carry cargo. Bucket trucks, cherry pickers, cement mixers, dump trucks, including garbage trucks, flatbed trucks, and refrigerated trucks. Combines, cranes, derricks, and forklifts. Delivery trucks with seating only for the driver or only for the driver plus a folding jump seat. Qualified moving vans. Qualified specialized utility repair trucks. School buses used in transporting students and employees of schools. Other buses with a capacity of at least 20 passengers that are used as passenger buses. Tractors and other special purpose farm vehicles. A qualified personal use vehicle can also include trucks and vans that have been specially modified so that they are not likely to be used more than a minimal amount for personal purposes, such as by installation of permanent shelving and painting the vehicle to display advertising or the company's name. Maximum depreciation deduction for passenger automobiles. So this long description I gave you of all of the things that are not passenger automobiles, it's really relevant because when you're not a passenger automobile, the limits I'm about to describe don't apply to you. But if you are a passenger automobile, and most cars on the road are, then these limits do apply to you. For 2012, the maximum total depreciation in Section 179 deduction you can claim for a passenger automobile placed in service is $11,160. However, if you elect not to claim any special depreciation allowance for the truck or car, then the vehicle is not qualified property and the maximum deduction is reduced to only $3,160 for the year. If your vehicle is less than 100% business use, your maximum depreciation allowance must be multiplied by the percentage business use of the vehicle. The following table comes from MACRS Publication 946 on pages 62 through 63, and it outlines the maximum deductions allowed for each year for passenger automobiles. You will see that for 2012, the maximum first-year deduction is $11,160. For 2011, it was $11,060. 2010, $11,060. When you go back to 2007, there was no bonus depreciation in place for 2007, and therefore the maximum depreciation deduction for 2007 in the first year of a vehicle is $3,060. Now, if you have an asset that you place in service, a car that you place in service in 2012, and you do not elect bonus, read this little asterisk here. It says $11,160 with a little 1 next to it. Follow that down. It says, if you elected not to claim any special depreciation allowance for the vehicle for the year, the vehicle is not qualified property, and then the maximum deduction is limited to $3,160. Second year depreciation on the vehicle is limited to $5,100, the third year $3,050, and for the fourth and all later years, $1,875. So let's take a look at an illustration of what happens when a person does not claim bonus depreciation in the year they acquire a vehicle. On April 1, 2012, you purchased and placed in service a 2012 Dodge Caravan that cost $35,000. Since the vehicle weighs less than 6,000 pounds, it is considered listed property and is subject to the limits on automobiles. According to your records, you used that 2012 Caravan 30% for personal use and 70% for business use. You elected not to claim 50% special depreciation allowance, and you will calculate your depreciation as follows. In the first year, year one, if you take the acquisition cost of the vehicle, $35,000, and multiply that by 20% for 200% declining balance, if it weren't a car, the first year depreciation deduction would be $7,000, except for the part where it's only 70% business use. So then you take $7,000, multiply it by 70%, and you get $4,900. But because this is a passenger automobile, you don't get $4,900, you don't get $7,000, you're not going to get close to that. The maximum amount of depreciation you can claim in that first year is $3,160, except for the part where it was only 70% business use. So instead of taking $3,160 in the first year, you're going to get 70% of $3,160, which is $2,212. So because the car is a passenger automobile, you don't get what would otherwise have been allowed as a $4,900 deduction. You are allowed to claim only $2,212 because you elected out of bonus. Now here is the same type of situation, but this time we have not elected out of bonus. In other words, we are going to claim the special depreciation allowance for the vehicle. And in this case, we've got a purchase price of $35,000. And remember, the special 50% allowance would give us 50% of the cost in the first year, $17,500. Except because it's a passenger automobile, we're going to be limited to $11,160. And then we have to multiply $11,160 by 70% business use, $78,12. So you're going to take $11,160, multiply that by 70%, you get $78,12. Now, how to calculate depreciation after you claim 100% allowance? Well, in year one, we're going to enter $11,160, and then we're going to take $7,812 for year one. In year two, the limit reduces to $5,600. The deduction would be $5,600, but we're not going to be eligible to use that much because second-year depreciation for a car is limited to $5,100, and then we have to multiply that by 70%. In the third year, we're limited to $3,050. We have to multiply that by 70%. And in the fourth and all later years, we multiply $1,875 by 70%. So your first year allowable depreciation deduction amount is $7,812, and it is limited as I showed you above. Now, you might imagine that a car is 5-year property, and if you're limited on how much depreciation you're allowed to claim each year, you're going to get to the end of the recovery period and you will not have been able to deduct or recover the full purchase price of that car or the cost basis of that car, and you've reached the end of the depreciation period. So that's okay. IRS says if the depreciation deductions for your automobile are reduced under the passenger automobile limits, you will have unrecovered basis in your automobile at the end of the recovery period. If you continue to use the automobile for business, you can deduct that unrecovered basis after the recovery period ends. You can claim a depreciation deduction in each succeeding year until you recover your full basis in the car. The maximum amount you can deduct depends on when you placed that car in service. Note that you cannot claim a depreciation deduction for listed property other than passenger automobiles after the recovery period ends. So here we have the depreciation limits for trucks and vans. And IRS says you might still have a truck or a van that weighs less than 6,000 pounds. 6,000 pounds is a very magic number. When you hit 6,000 pounds, you are considered not to have a passenger automobile. You have something else, and so the limits on automobiles don't apply. Therefore, it is possible, though, to have a vehicle that doesn't look like a passenger automobile but is still treated as if it was one. And if you have a situation like that, then you get an extra $200 of depreciation in the first year. It's a whoopty big number, huh? But what we're talking about here are trucks and vans. So let's say you've got a light pickup truck. It weighs less than 6,000 pounds. I have an image here of one. I went on the internet and found it looks like a Silverado 150 type truck, or 1500 they're called, aren't they, when they're GMC. So I've got the Silverado 1500, and when I went online and looked it up, it weighs less than 6,000 pounds, and therefore it's considered to be a passenger automobile, but it doesn't get subject to the passenger automobile limits. Instead, it gets subjected to the depreciation limits for trucks and vans. And essentially, you'll see that under automobiles, we had $11,160 as the limit for bonus. For trucks and vans, it's $11,360, so it's a whole $200 higher. And then in the second year, allowed $5,300. In the third year, $3,150, and the fourth and later years are the same as for passenger cars. Other property used for transportation. IRS Publication 946 specifically states that vehicles weighing more than 6,000 pounds or used to transport persons or property for hire are not passenger automobiles. However, they are still other property used for transportation, and therefore they are subject to the special rules for listed property. Other property used for transportation includes trucks, buses, boats, airplanes, motorcycles, and any other vehicle used to transport persons or goods. Now, a few years ago, we're talking 2004, some new rules came out that affected SUVs, sport utility vehicles. And what those rules did is they put a restriction on the amount of Section 179 deduction that can be claimed for that vehicle in the year it's placed in service. And the most that you are allowed to claim under Section 179 deduction for the purchase price of a SUV is going to be $25,000. So here it looks like we've got a picture of a Ford Explorer. That's assuming it weighs over 6,000 pounds. This vehicle can be pretty spendy. It wouldn't be hard to spend over $40,000 on it. But the most that you would be allowed to claim under Section 179 is $25,000 for that vehicle, and then you would need to depreciate the remaining balance. Limits on claiming a Section 179 deduction for purchase of an SUV. The maximum Section 179 deduction for certain sport utility and other vehicles placed in service after October 22, 2004 is $25,000. The portion of the vehicle's cost taken into account for figuring the Section 179 deduction for property use less than 100% for business is also limited to $25,000. So what that's saying is, let's just suppose you purchased an SUV costing $50,000 and you're using it 70% for business. Well, you would multiply $50,000 by 70% to come up with your cost basis for depreciation, and you would be allowed to claim a Section 179 up to $25,000 of that deductible basis in the car or in the SUV. All right, so which SUVs are affected? This $25,000 limit on Section 179 deduction rule applies to any four-wheeled vehicle primarily designed or used to carry passengers over public streets, roads, or highways that is not subject to any of the passenger automobile limits and is rated at no more than 14,000 pounds gross vehicle weight. So I have a picture up here of a typical SUV. This is what I imagine and what the IRS is imagining when they describe an SUV. You're looking at the Ford Explorer type vehicle, the Ford Expedition, the Yukon Denali, the Suburbans, the Tahoes, those cars. Those are what they're thinking of. But when you think of sport utility vehicle, when I think of sport utility vehicle, we might be thinking of more than just the Suburban type vehicle. And so just to clarify it, we have a list of property that could be considered to be an SUV, but it's specifically excluded from that $25,000 limitation. And the first of these vehicles is a vehicle designed to have a seating capacity of 9 or more persons behind the driver's seat. So I went on the internet and I found you a nice diagram of a vehicle that has space for 9 or more persons behind the driver. And there's 3 people per row. This is a 12-passenger vehicle, so we have 3, 6, 9. 9 seats behind the driver, therefore this is not going to be limited by the $25,000 limit on SUVs. Then we have equipment, or the vehicle is equipped with a cargo area of at least 6 feet in interior length that is an open area or is designed for use as an open area, but is enclosed by a cap and is not readily accessible directly from the passenger compartment. Well, that's a pickup truck. So that's interesting. Lots of people go out there, and some of them are interested in the SUVs that are fully enclosed and can, seat 6 to 8 people. And then other people go out there and buy the pickup truck, and the pickup truck can still seat up to 6, if it's nice, one of those crew cab ones. But the pickup truck does not fall under those limits. It's not restricted under the $25,000 limit because it meets this description. And finally, also not affected by the $25,000 limit is a vehicle that has an integral enclosure fully enclosing the driver compartment and load-carrying device, and does not have seating rearward of the driver's seat and has no body section protruding more than 30 inches ahead of the leading edge of the windshield. Well, that was an interesting one. This kind of sounds like what we're looking at right here. Basically a delivery van. It's got a short little nose. It's got room for the driver, and it's all cargo back here with no seats. So if your customer, your tax client, purchased any of these 3 kinds of vehicles, then they are not going to be limited to $25,000. They will be allowed to claim a full Section 179 deduction for the vehicle if they choose to. However, you do need to remember that these are still listed property, and because they're listed property, you still have to report them in Part 5 and track their business use in Part 5 of Form 4562. Leasing a vehicle. Well, you might be thinking to yourself, okay, maybe I'll get around those limits on passenger cars by leasing a vehicle. Then I don't have to worry about the depreciation limits. I could just claim my lease payment and be done with it. Multiply my lease payment by percentage business use, and I have a deduction, sweet and simple. Well, that's mostly true. For the most part, it is true, but it's not that easy. Let's see why. Leasing a vehicle. If you lease a car, truck, or van that you use in your business, you can use the standard mileage rate or actual expenses to figure your deductible expense. How do you deduct lease payments? If you choose to claim actual expenses for your leased car rather than the standard mileage allowance, you can deduct the portion of your lease payment that corresponds to the percentage of business use, subject to the following restrictions. You cannot deduct any part of a lease payment that is for personal use of the car, such as commuting. You must spread any advance payments over the entire lease period, and you cannot deduct any payments you make to buy a car, even if the payments are called lease payments. So I do have people ask me sometimes, how do I know if the leased car is a lease or and when it's not really a lease and it's a purchase? And I say, well, it's the intent of the buyer. If you go down to the dealership and you purchase a car and you make a decision that you're going to lease it rather than buy it because it gives you a lower monthly payment, it makes it more affordable to you, but your full intention is at the end of the lease term to keep that car and then refinance it or purchase it back from the leasing company so that you can then keep it, then in that situation what you're really doing is using the lease company as a form of financing, and that would be considered to be a purchase. But if you plan to return it at the end of the lease period, the intention is you're going to lease it for the 3 years or the 5 years or the 2 years, however long the lease term is, and that you know at the end of that period you're just going to turn it back over, then that really would be a lease. So I say it just depends on the intention. Inclusion amount. That's where part I mentioned. You have to refer to publication 463, page 24 for information about inclusion amounts. If you leased a car that you use in your business for a lease term of 30 days or more, you may have to reduce your deduction for your lease payment by an inclusion amount. The purpose of the inclusion amount is to create an effect similar to the limit on the depreciation deduction you would have on the car if you had owned it. The inclusion amount is a percentage of the part of the fair market value of the car multiplied by the percentage of business and investment use of the car for that tax year. It is prorated for the number of days of the lease term in the tax year. You must apply the inclusion amount each year you lease the car if the fair market value of the car at the time you begin your lease is more than the amount shown in the following table. And here we have the year the lease begins. If you purchase the car between 2010 and 2012 and the fair market value of the car exceeds $19,000, then you're going to have to figure an inclusion amount. And if you go back in time, that fair market value of the car at the time you acquire it is, of course, a lower value. So it is pegged for inflation somewhat. So how do you go about calculating the inclusion amount of a vehicle that you have leased? Well, inclusion amounts are listed in IRS Publication 463 with a series of 3 tables. Appendix A is for cars, Appendix B is for trucks and vans, and Appendix C is for electric cars. And if the fair market value of the car is $100,000 or less, you will use the appropriate appendix, depending on the year you first placed the car in service. To determine the inclusion amount, if the fair market value is more than $100,000, you would need to see revenue procedures for instructions on how to calculate it manually because the table runs out. For each tax year during which you lease the car for business, determine your inclusion amount using these 3 steps. Step number 1, locate the appendix that applies to you, Appendix A, B, or C. And then find the inclusion amount in there. So you will find the line that includes the fair market value of your car on the first day of the lease term. Then you will follow that line across the column for the tax year in which the car is used under the lease to find the dollar amount. For the last tax year of the lease, use the same dollar amount as for the preceding year. Step number 2, prorate the dollar amount from line 1 up here by the number of days of the lease term included in the current tax year for which you are claiming the deduction. And then finally, multiply the prorated amount in Part 2 by the percentage of business use and investment use for the year, and you have your inclusion amount. Well, that all sounds lovely. How does it work on real paper when we're taking that and following the instructions? Well, I created an illustration for you to see how it all comes together. On February 1st, 2012, McQueen leased a car for 3 years and began using it in his business. The car had a fair market value of $42,500 on the day he signed the lease agreement. His monthly lease payment is $600. McQueen used the car 70% for business purposes during each year of the lease. Use Appendix A5 to calculate the following inclusion amounts for each year of the lease. So I've done the work for you, and I'm telling you that these are the answers. For 2012, the inclusion amount is going to be $10. So I'm going to do all of that work on a $42,000 car, and all I come up with is $10? Are you kidding me? That's true. So if in your ordinary course of business you have never in your life figured an inclusion amount, probably the case is that the sky is not falling, but you still do need to know what it is, and you should still be calculating it because, of course, we all want to be perfect in our work, right? So these are the inclusion amounts, and they represent an amount that McQueen is not allowed to deduct. For each lease year payments are being deducted, you must reduce the depreciation deduction by the inclusion amount computed for that year. For 2012, calculate McQueen's inclusion amount as follows. And I'm telling you we're going to get to this $10 inclusion amount. The first step is find the inclusion amount on Appendix A5 corresponding to the original fair market value of $42,500. And I actually have that page from that table right here. So I've gone in and I've cut and pasted a picture of the table. And you can see on this line right here, it says the fair market value on the beginning date of the period of lease, $42,500. We're going to follow this line that is at least $42,000, but not more than $43,000. We'll follow it across, and it says in the first year it's $16, the second year $34, the third year $51, and oddly enough, it gets bigger each year. I think that's interesting too. So we found the line that carries the corresponding amount. And in looking at that table for the first year, the table shows us that the number we're interested in is $16. Now we're going to multiply $16 by the ratio of the number of days in use in 2012. And since the car was placed in service on February 1st, and since 2012 was a leap year, we're going to determine that the car was leased for 335 out of the 366 days of the year. So we're going to take 335 divided by 366, multiply that by $16, and we have an inclusion amount of $15 after all that. We're then going to multiply the prorated dollar amount by the percentage business use for the year. $15 times 70% gives us a $10 deduction, or a $10 inclusion amount for the first year. For 2012, let's assume that McQueen made 10 lease payments for his car during the year. His allowable lease deduction would be figured as follows, totaling $4,190. We'll take $600 per month times 10 payments is $6,000. We'll then multiply that by 70%, and we come up with $4,200. The first year from the table is $16, but we have to multiply that by the percentage business use and the number of days in use, and we get $10. We then subtract 10 from 42, and we get $4,190. So we do all of that to figure out the amount of lease expense that we can claim a deduction for on McQueen's business tax return. So we're not depreciating. We're not going to claim a depreciation deduction for the leased vehicle. We are claiming a deduction for the lease payments he's making on the vehicle. And we cannot claim a lease payment to the extent that the payment went for personal use, nor can we claim a lease payment to the extent we have to factor in an inclusion amount. In other words, the deduction is reduced by whatever inclusion amount we figure out. Now for 2013, McQueen's lease deduction is going to be $5,016, and here's how we calculate it. This time we've got the vehicle all 12 months, so we have 600 times 12 payments of $7,200. Then we take $7,200 and multiply that by the percentage business use. We end up with $5,040. In the second year, the inclusion table shows us that $34 is the inclusion amount, but we need to multiply that by the percentage business use, and when we do that, we get $24. We subtract 24 from 5,040, and we have the 2013 lease deduction, $5,016. In the next year, the inclusion table shows us that the number is $51. We're going to multiply that by 70% to get 36. We subtract 36 from the total lease payments multiplied by the percentage business use, and when we do that, we get the deduction, $5,004. In the third year, we're into the final year of the lease. McQueen will end the lease on January 31, so he'll only have that car for 1 month of 2015. His lease deduction for 2013 will be calculated as follows. He'll start with the $600 payment he makes for January. He'll multiply that by 70% business use to get $420. For the final year of the lease, we'll show that we're going to use $51 because that's the amount that was in play the year before the final year. We're then going to multiply that by the number of days in use for the year and by the business use percentage. And when we're done with that, we're left with $3. Woohoo! And we're going to subtract 3 from 420, and his lease deduction for his final year of business use of that vehicle is going to be $417. So here again we have the inclusion amount table, and if you were to go to publication 453, you will see that it is page after page after page of these tables, and I've just pulled one of them out for you. So here is a summary of the passenger automobile rules. The amount of depreciation and Section 179 deduction that you can claim on passenger automobiles is limited. A passenger automobile is any four-wheeled vehicle made primarily for use on public streets, roads, and highways and is rated at 6,000 pounds or less. Passenger car limits and listed property. Depreciation limits apply to passenger cars weighing 6,000 pounds or less. SUVs and vans with gross vehicle weight ratings of 6,000 pounds or more are not considered to be passenger cars. Therefore, they are not subject to the limits that affect passenger cars. But SUVs and vans weighing more than 6,000 pounds are still considered listed property. You can only claim a Section 179 deduction on the vehicle if it is more than 50% business use. And then again, we're revisiting this table to show you the maximum amount of deduction you are allowed to claim for all of the years at issue. And I can see we're just about to amortization, and we're also due for a 10-minute break. So I'm going to give you a little bit of information on the standard mileage allowance, and then we're going to take a 10-minute break. And during that 10-minute break, I'm going to give you a classwork assignment to take a look at. I mentioned it before lunch, but we're going to come back to it seriously now. And then we'll move on to amortization. So the standard mileage allowance is the next topic. And if you decide that you're not going to be bothered with depreciating your car and you're not going to be bothered with tracking actual expenses, which, by the way, is something I really recommend for most business owners. Keeping track of the mileage is a heck of a lot easier than keeping track of the mileage, plus also keeping track of expenses. So if you're eligible for standard mileage, odds are it's the better choice. Now, even if you do claim the standard mileage allowance, you should be aware of the fact that a part of the standard mileage allowance is pegged for depreciation. Now, you can claim the actual expenses of operating your car or vehicle, or you can claim a standard mileage allowance. And for 2012, the standard mileage allowance is 55.5 cents per mile. And for 2013, it's increasing by a penny to 36.5 cents a mile. These rates are meant to cover all of the costs of operating your car, including gas, oil, repairs, and depreciation. Now, if you claim the standard mileage allowance during 2012, 23 cents of each mile you claim is for depreciation. The remaining 32.5 cents per mile is allocated to the operational cost of the vehicle. While MACRS limits your depreciation deduction that you are allowed to claim when you claim actual expenses, it does not limit the amount of depreciation you are allowed to claim if you are claiming the standard mileage allowance. So the standard mileage allowance, you're simply going to multiply the number of business miles driven on that car by the mileage allowance of 55.5 cents a mile, and you're allowed that number. You don't have to worry about limits on the passenger cars. And one added point here, when you're looking at maintaining a car, the IRS says that when you purchase a car, the tires that come with the car are part of the acquisition cost of that car. They're part of the basis of the car. But once those tires are worn out and you replace them with new tires, the IRS says that the cost of replacement tires purchased during the year is allowed as an operating expense of the vehicle. That means tires cannot be claimed in addition to the standard mileage allowance, but if you are claiming actual expenses, you can claim the cost of replacement tires. So let's take a look at the end of our manual here for classwork assignments. And we did classwork assignment 2 a little bit earlier in the day. I'd like you to get a start on classwork assignment 3 now, and you can see 3 involves quite a number of depreciable assets, and it also asks you to fill out Form 4562. And I have not gotten to the part where I'm showing you how to fill out 4562 right now, so I would rather you just instead do the depreciation schedule. So do your best of creating your own depreciation schedule. So you'll just have to make up a depreciation schedule on a scratchy piece of paper, figure the depreciation on each of the assets that you see here, and I'll go over with you what the actual deductions allowed are. EMU, E-M-U, EMU. Okay, everyone, you can see I was working kind of hard to fit all of these poll questions around the problem without covering the problem. Hopefully you are able to see it. All right, then, I'm going to show you a very detailed answer key coming up in just a second. But before then, I wanted to take these assets one at a time. So the first asset that we're looking at is the car. And the instructions say do not take 50 or 100% bonus on any asset. But do take a Section 179 deduction where you are allowed. Assume that the business income is $515,000 because you, of course, cannot take a deduction that exceeds your business income, so we're well and fine in that regard. And then for the car, assume the following, that the business miles are 12,000, the total miles are 23,500, and that the commute miles are 4,000. Well, what we're interested in is a percentage, and the percentage is the percentage business use. We're going to take 12,000 and divide that by $23,500, and when we do that, which I can't do in my head, we get 51% business use. 51% business use means that we're allowed to claim a Section 179 deduction on that car because it is used more than 50% for business. But we're allowed 51% of what number? Since we're electing out of bonus, we're allowed 51% of the maximum deduction allowed for passenger automobiles in the first year they are placed in service. And that number, that limit, is $3,160 for 2012. So in effect, the correct answer for classwork number 3 with regards to the car is what is the depreciation deduction that you figured? Well, you're going to be allowed a maximum deduction of $1,612. This is a really good problem for me to put in front of you because I can guarantee you that for as many years as I've been teaching this class, even after I give a very long lecture and include illustrations on how to figure the limits on passenger automobiles, I then throw a question like this in front of my audience, and more than half get it wrong. So if you're in the part that got it wrong, that's normal, but hopefully it's now making a little bit more sense to you. So get rid of the car and move on to the next in list. That's the office building and the land. And that was up here with this assignment. So let's take a look at this baby right here. Put it in the middle of the screen so we can focus on it. All right, so for the office building and the land, we're not going to be allowed to depreciate the land, and the life of the office building is going to be 39 years. So we have to subtract the land value from the cost of the building. So we're going to take $250,000 and subtract out $75,000, and that leaves us with a basis for depreciation of $175,000. We're going to divide 175 by 39 years, and then you can see that this asset was placed in service in an earlier year, 2011. So we're not going to have to do the mid-month convention. We're done. We're going to take 39 and divide that into 175,000, and when we're done, we've got our deduction. And our deduction for this asset is going to be $4,487. Okay, the next asset in line is the cell phone, and that's down here. So broadcast results on the cell phone. Let's talk a little bit about the cell phone. The right answer is $10. How do we get $10 on that cell phone? Well, remember that cell phone is not listed anywhere in the tables for classes of assets. Doesn't seem to be identified anywhere, and therefore, since it's not classified, we say it's 7-year property. And when you're dealing with 7-year property, you also have to look at the rules for Section 179. Well, you're not going to be able to take a Section 179 deduction on an asset that's used 50% or less in business. This is used 45% for business. A deduction is allowed, but we're essentially going to take $150 times 45%. That gives us a depreciable basis of $68. We're then going to divide 68 by 7 years, and then we're going to divide that by 7 years, and we get our $10. So the cell phone, we're going to get $10 of depreciation on. All right, so then, done with the cell phone. The next one we have is the laptop computer. What have we got to say about that? Well, it's 45% business use and it's listed property. That means it's not eligible for a Section 179 deduction. It's going to have to go straight line as well. And so what we're left with is figuring $2,500 times 45%, then dividing the difference or the multiplied number by 50%. And we're not going to be allowed to take double declining balance. So we're ending up with, on the laptop computer, with a pretty small number. And that small number is $113. And then moving on to the desktop computer, what do we have to say about the desktop computer? It's used in a home office. And IRS says that a home office is an established business location. And computers that are used in an established business location are not listed property. But even if it was listed property, it was 100% used for business, and I've told you in the instructions up here, take a Section 179 deduction where it is allowed. Well, we're finally onto an asset that is allowed to claim a Section 179 deduction. And so the correct answer for the desktop is as easy as pie. The desktop computer, the correct answer is $800. On to the desk. The desk is also eligible for the Section 179 deduction. It was placed in service during the year. It's 100% business use. 100% of $450 is, well, $450. That is the correct answer. Now, in the rental property, we have two assets, but I only managed to make a poll question for the first one, which is the rental home itself. And the rental home itself is $150,000. It was placed in service in January of the year, and it is got a land value of $50,000. So we've got essentially a depreciable basis of $100,000. We're going to divide that by 27.5 years, divide that by 12 months in the year, and then we're going to multiply that by 11.5 this time because we have half of the month of January plus all the rest of the year. And when we're finished doing that computation, we end up with a deduction for the rental home that is $3,485. And the very last item in line is the refrigerator in the rental home. And I don't have a poll for it, but hopefully you got far enough to figure that one out anyway. Now, when we're dealing with a rental home, because that refrigerator is used in a rental home, no Section 179 deduction is allowed. So there is an acquisition cost on that refrigerator of $500. Now, normally we might think of a refrigerator as 7-year property, but the deal is if you go to the classification tables and other instructions in 946, you will learn that any asset that is not real property that is used in your rental property is going to be 5-year property. So although on the surface the refrigerator looks like it should be 7-year property, it is in fact 5-year property, and it is eligible for double declining balance. So we're simply going to take 20% of $500, and that's going to be the first year deduction, and therefore the deduction is going to be $100. So if you figured $100 for the refrigerator, good work. And I'm going to now pull up, as I promised, the full answer key so you can see all the descriptions in this. And the answer key for this assignment and all of the other assignments we've worked on today is available to you inside the Open Campus Learning Management System. You can go there and see it and read it after class is over today. So we're going to start with the car since that was the most confusing one on the list. The car is subject to the limits on passenger cars. That means the maximum allowable depreciation deduction for that car in the year it is first placed in service is $3,160. Just a flat number. We can't go beyond that because we elected out of bonus. Had we elected into bonus, we would have been allowed the percentage business use multiplied by 11,160. But we didn't elect into bonus, we elected out of bonus, so we're restricted to $3,160, but we don't get to deduct that number. That's the most we can deduct, and we have to multiply that by the percentage business use. Well, where did I get the percentage business use? We take the total number of miles that the car was driven during the year for business and divide that by the total number of all miles driven for that car for business. I don't know that if I have that computation right here, but let's go back to the problem. Because it says right here, the business miles are 12,000 and the total miles are 23,500. Well, if you take 12 and divide that by 23.5, you get 51%. And 51% of 3,160 is $1,612, and that's why that is the correct answer. Let's move on to the laptop. We have a $2,500 purchase price. We're going to multiply that by 45% business use. That gives us a basis for depreciation of $1,125. It is 50% or less business use, and that means that it's going to fall under the ADS rules, and that's 5-year property, but we're not going to be able to use double declining balance, the 200% declining balance. So we're going to take $1,125, divide that by 5 years, multiply that by the half-year convention, and we're left with $113. The desktop computer is 5-year property. It is not listed property because it is used at a place of business. It's eligible for the Section 179 deduction. Our deduction is there for $800. Same too for the desk. It's eligible for the Section 179 deduction, 100% business use. We're going to claim $450. And then on the office building, we're going to take the land value, subtract that from the purchase price. 75 from 250 is 175 over 39 years. Since this is the second year that the commercial building is in place, no mid-month convention to worry about. We simply take $175,000, divide that by 39 years, and we get $4,487. And then we go into the cell phone. Basis for depreciation on the cell phone also is $150, but we're going to multiply that by the percentage business use. We get a depreciable basis of $68. Section 179 deduction is not allowed. We have to depreciate at ADS because it's not more than 50% business use. Therefore, we take $68, divide that by 7 years, and we get $10. Next up is the rental home. $150 cost in the home minus the land value is $100,000. Take $100,000, divide that by 27.5 years, and you get $3,636 per year. You then have to divide that by the 12 months in the first year it was placed in service and multiply that by the number of months based on the mid-month convention. That's 11.5, and we get $3,485. And then finally on the refrigerator, the appliance in the rental home is given a 5-year life. The cost is $500. We simply multiply that by 20% to apply first-year double declining balance, and we get $100. And I did see a chat up there. Where can I go to find this answer key? It's inside the LMS. Same general area as you went to print the manual. If you got as far as printing the manual, the answer keys are in that same area under materials. We're going to look at the 4562 later. I'm reserving that for later because I haven't shown you all of the details of 4562, so it wouldn't be really fair to force you to do it quite yet. But it's coming up fast and furious soon, I assure you. So we left off with the next topic of the day being amortization. Amortization starts at the bottom of this page here, page 52. So if you're all with me again, amortization is a method of recovering or deducting certain capital costs over a fixed period of time. It is similar to the straight line method of depreciation, but different. In general, you cannot depreciate intangible property placed in service after August 10, 1993, and the following property cannot be depreciated and must be amortized instead. It includes geological and geophysical expenditures, pollution control facilities, certain bond premiums, research and experimental expenditures, the cost of acquiring a lease, qualified forestation and reforestation costs, optional write-off for certain tax preferences over the period specified in Section 59E, certain Section 197 intangibles including goodwill, going concern value, workforce in place, business books and records, operating systems, or any other information base, a patent, copyright, formula, process, design, pattern, know-how, format, or similar item, a customer-based intangible, for example, composition of market or market share, a supplier-based intangible, a license, permit, or other right granted by a governmental unit, a covenant not to compete entered into in connection with the acquisition of a business, and a franchise, trademark, or trade name, including renewals. Also, business startup costs, organizational costs for a corporation, and organizational costs of a partnership. Now you'll notice that I've entered section codes down here, Section 195, Section 248, Section 709. When you complete 4562 and place an asset in service for amortization, the 4562 asks you what section codes you are using to amortize. And so I've provided where I could find it, the amortization code or the section code that you're going to need to enter on 4562. And of course, Section 197, and then we have Section 195 for these. Creative property costs. These are costs paid or incurred to acquire and develop screenplays, scripts, story outlines, motion picture production rights to books and plays, and other similar properties for purposes of potential future film development, production, and exploitation. You may be able to amortize creative property costs for properties not set for production within 3 years of the first capitalized transaction, and these costs are amortized ratably over a 15-year period. Reforestation costs. You can elect to deduct up to $10,000 of reforestation costs paid or incurred after October 22, 2004, and costs that are not deducted currently are amortized over an 84-month period rather than the normal 15-year period. Startup and organizational costs, these are one of the more common ones I run across in my tax practice, and so I've kind of focused in on these, and we'll spend a bit of time talking about them. When you start a business, you treat all eligible costs you incur before you begin operating the business as capital expenditures, which are a part of your basis in the business. Generally, you recover costs for particular assets through depreciation deductions. However, you generally cannot recover other costs until you sell the business or otherwise go out of business. You can elect to amortize with certain limits and deduct the following costs for setting up your business. And that includes business startup costs under Section 195, organizational costs for a corporation under Section 248, and organizational costs for a partnership under Section 709. Business startup costs are amount that you paid or incurred for creating an active trade or business or investigating the creation or acquisition of an active trade or business. Startup costs include amounts paid or incurred in connection with an existing activity engaged in for profit and for the production of income in anticipation of the activity becoming an active trade or business. Business startup and organizational costs can be capitalized, amortized, or within certain limits deducted. If you choose to amortize your business startup costs, you do so over 180 months. Organizational costs can include the costs of creating a corporation or a partnership. So although you might think of filing paperwork with your state to incorporate your business as a startup cost, the IRS actually says that's an organizational cost, and you would separate that out, and it would be entered on Form 4562 with a different code next to it and not mixed in with other startup costs. So what are qualifying costs? A startup cost is amortizable if it meets both of the following tests. Number one, it is a cost you could deduct if you paid or incurred it to operate an existing trade or business in the same field as the one you entered into. And it is a cost you pay or incur before the day your active trade or business begins. Startup costs can include amounts paid for the following: an analysis or survey of potential markets, products, labor supply, transportation facilities, etc., advertisements for the opening of the business, salaries and wages for employees who are being trained and their instructors, travel and other necessary costs for securing prospective distributors, suppliers, or customers, and salaries and fees for executives and consultants or for similar professional services. So what you're hearing there in this description of things that have to be treated as startup are really all of the types of things that you would normally spend money on in the ordinary course of operating your business. You would normally spend money advertising it. You would normally have employees stocking shelves, serving customers, doing the day-to-day work that needs to be done in the business. And what the IRS says is all of the costs that you pay before the day you open your doors for business are startup costs, and they're not deductible. They're not operating expenses. They're startup costs, and because they're startup costs, you have to capitalize them. And if you do any recovery of that cost, you do so through amortization. You wouldn't turn around and claim any part of an item that is considered to be a startup cost as an actual operational expense of the business, even though after the business starts operating, you could deduct it as an operational expense of the business. So what are some non-qualifying costs? Well, startup costs do not include deductible interest, taxes, or research and experimental costs. Purchasing an active trade or business. Amortizable startup costs for purchasing an active trade or business include only investigative costs incurred in the course of a general search for or preliminary investigation of the business. These are costs that help you to decide whether to purchase a business. Costs you incur in an attempt to purchase a specific business are capital expenditures that you cannot amortize. Disposition of a business. If you completely dispose of your business before the end of the amortization period, you can deduct any remaining deferred startup costs. However, you can deduct these deferred startup costs only to the extent they qualify as a loss from a business. How to make the election. To elect to amortize startup or organizational costs, you must complete and attach Form 4562 to your return for the first year that you are in business. You may also be required to attach an accompanying statement to your return. For startup or organizational costs paid or incurred after September 8, 2008, an accompanying statement is no longer required. If you have both startup and organizational costs, attach a separate statement if required to return for each type of costs. Generally, you must file the return by the due date, including any extensions. However, if you timely filed your return for the year without making the election, you can still make the election by filing an amended return within 6 months of the original due date of the return, excluding extensions. Once you make the election to amortize startup costs or organizational costs, you cannot revoke it. And what about those costs paid before October 23, 2004? Some of you may remember in your head, wasn't amortization for startup 60 months? And the answer is yes, it used to be 60 months, but that's almost 9 years ago now. Now we've been on this 15-year rule for a long time, so that should be cemented in your head by now. Now for costs paid after October 22, 2004, you are allowed to make an election to deduct up to $5,000 of your startup costs as a deduction on your return and treat it as a business expense rather than amortizing it. The maximum deduction is reduced, however, by the amount that your startup or organizational costs exceed $50,000. So most of the small business owners I talk to, their startup costs are well under $5,000. But you could certainly have a larger business that does have a lot of startup costs. And IRS says essentially when you get to be a big enough startup, you're going to be forced to amortize all of the costs. You're not going to be allowed to deduct any of them. Now, you are not required to attach a statement to make the election to claim the deduction, but once you make the election, it is irrevocable. And how do you make the election? Well, you simply claim it as an expense deduction on your return. That proves that you made the election. Any cost not deducted currently must be amortized ratably over a 180-month period. The amortization period starts with the month you begin business operations. When startup or organizational costs exceed $50,000, the $5,000 figure must be phased out, and any remaining cost not currently deductible is amortized over the 15-year period. The amortization period starts with the month you begin business operations. And another thing about amortization is there's no mid-quarter, no mid-month, no half-year convention that applies. If you have a startup cost that you place in service during the year, and you have that startup cost begin in June, you would get actually 7 months of amortization in full, even if you put it in service on June 30th, because you would be allowed all of the first month it was in service plus all of the remaining 6 months of the year. So amortization rules do not include any of the rules we were learning about earlier for conventions. Now here's an illustration of how we would deal with startup costs on a depreciation schedule. Fred Finch incurred the following expenses as he prepared for the 2012 grand opening of his new business called For the Birds, Inc. He had organizational costs of forming the corporation, which were $2,000, travel costs while researching competing businesses of $1,000, meal expense while he traveled for business, $200, 2 months of rent paid before the grand opening, $3,000, auto mileage prior to the grand opening, $500, opening soon advertising, $2,500, payroll for training staff and getting the business ready to open, $4,000, payroll taxes prior to the grand opening of $400, utility costs for 2 months before the grand opening of $500, and inventory purchases of $50,000. And how is Fred going to treat all of these costs? Well, just zoom in a little here and make it bigger for you. Firstly, we're going to look at what is going to be treated as a Section 195 startup cost. It's going to include the travel, 50% of his meals, 2 months of rent before opening, auto mileage, opening soon advertising, payroll for training staff, payroll taxes, and the utility costs. When you add all of that up, you get $12,000. So how are we going to treat this? Well, Fred is going to be allowed to deduct up to $5,000 of that $12,000 if he chooses. And then he would amortize the difference, $7,000, over a period of 180 months, 15 years. The organizational costs, the cost of forming that corporation, are $2,000, and they are less than $5,000, so he can elect to deduct them in full, or he can elect to amortize them. It's his choice. And then we have this item here of inventory. Well, inventory is not a startup cost. Inventory will add to his cost of goods sold. It will appear on his business tax return in the inventory section as an inventory purchase for the year. I did want to make a note here about 2010 startup costs. There was a rule in play for 2010 only, and it was that if your business began in 2010, you could elect to deduct up to $10,000 of business startup costs paid or incurred after 2009. The $10,000 deduction was reduced but not below zero by the amount that startup costs exceeded $60,000, but that $10,000 rule was in play only for 10. So I promised we would eventually get to 4562, and we're just about there with like an hour and a half left in the day, so our time is looking okay so far. So how do you claim amortization? Well, to claim amortization, complete Part 6 of Form 4562. Attached asset costs that begin in 2012 are entered on line 42, which is this line right here. Zoom in again. So it says Amortization Part 6, line 42, amortization costs that begin during 2012. And then on line 43, it says amortization of costs that began before 2012. And you'll notice that it asks you to enter the date that amortization begins, the amortizable amount, the code section, I pointed those out earlier, the amortization period or percentage, and amortization for this year. And now we're on to 4562. So from this point, I'm going to go over a summary of the form. We've been looking at pieces and parts of it throughout the day-to-days. I've been trying to explain how different amounts are carried to the form. And now we're going to take a look at each of these parts a little more detail. Page 2 of the form. And let's now talk about this first part, Part 1. Part 1 is used to make the election to expense certain property under Section 179. On line 1, you use Worksheet 1, shown on the next page, to figure the amount to enter on line 1. The maximum amount is usually $500,000. On line 2, you will enter the total cost of all property, including the total cost of qualified real property that you elect to treat as Section 179 property, placed in service during the year for all business activities of the taxpayer that is eligible for the Section 179 deduction in the first place. Now, if the taxpayer has more than one business, file a separate Form 4562 for each business activity. However, the amount that you show on line 2 will be the total for all assets placed in service in the combined activities. Do not include the cost of any asset placed in service that is not eligible for the election in the first place, such as real estate. On line 3, you'll use Worksheet 1 from the 4562 instructions to figure out the amount to enter on line 3, and usually the amount is $2 million. Now, I explained that there is a worksheet that we would get to that shows you how to figure whether or not you get $500,000 and how to figure out whether you get $2 million. And let's see what it says. Line 1, total cost of qualified Section 179 real property placed in service in 2012 for which you are making the election. And that would be qualified real property. That's basically leasehold improvements. Real property normally wouldn't even factor into the Section 179 computation. But if it's qualified real property, that means we're talking about leasehold improvement type property. Line 2, $250,000 of the maximum Section 179 deduction limitation of $500,000 is allowed for 2012 that can be expensed for real property. So again, if you are making improvements to a leasehold improvement, the maximum Section 179 deduction you can claim for that is $250,000, and so that's why this number is on the worksheet. We then enter the total cost of Section 179 property except the qualified real property placed in service during the year, and then we're going to enter the limit of $500,000. Now, if you are in an enterprise zone, you're going to get to add $35,000, and if you're in a disaster assistance zone, then you're going to get to add $100,000. And you do all of the computations to find out what your limit is that you will enter on line 1. And when you're done, most of the time it will be $500,000, but it could be less, as in $250,000 if you had no assets other than real property, and it could be more if you had enterprise zone or disaster property. And then on the next section it says, enter the $2 million, and if you have any qualified disaster assistance property, you're going to be able to claim a little bit more. For line 4, if the combined total of all assets shown on line 2 is more than the total of line 3, subtract line 3 from line 2 and enter the result here. And I have an example. XYZ Inc. placed $2,010,000 of Section 179 property in service for the year. We're going to take $2,010,000, subtract out $2 million, and we're left with $10,000. We would enter $10,000 on line 4, and ultimately we'd subtract $10,000 from $500,000, and that would limit our deduction to $490,000. That's in the very next part. Line 5, subtract line 4 from line 1, enter the result here. If the amount on line 4 is greater than the amount on line 1, the Section 179 deduction is 0. But in our case, XYZ reduces its maximum allowable Section 179 deduction by $10,000. $500,000 minus 10 is $490,000. XYZ can claim a maximum Section 179 deduction of $490,000. On line 6, we provide a description of each asset for which a Section 179 deduction is claimed, but do not list any asset that is listed property because you list listed property in Part 5 instead. On line 11, the total cost you can deduct is limited to your taxable income from the active conduct of a trade or business for the year, so you need to figure out what your profit is from the business without regard to the deduction and enter that on line 5. And of course, your deduction can't be more. Part 2 of the form is where you claim the special depreciation allowance, and I showed you that earlier today. Quite early in the class, we talked about how you figure the amount to enter on line 4, and for 2012, it's going to be typically 50% of the cost of the assets you placed in service for the year, assuming they're eligible for the deduction and you did not elect out of the deduction. If the qualified property was placed in service for the year, enter 100% or 50% if applicable, and most of the time it's going to be 50%. If you had that special property that was long-term contract property like an airplane and you finally placed it in service in 2012, you could have 100% on line 14, but more likely it will be 50%. On line 15, if you are electing to depreciate property using a unit of production method or other depreciation method not based on a term of years, enter the depreciation deduction being claimed here. also attach a separate sheet providing additional information about the item being depreciated under this system. I can say in my work I have never dealt with that. That's beyond the scope of my firm. Haven't dealt with it. Line 16, enter depreciation being claimed for these property types here. Acres property. That's kind of hard to have anymore because acres is all expired out, but they're still saying you can stick it there. Property placed in service before 1981. Certain property acquired from related persons. Property acquired in certain non-recognition transactions. Certain sound recordings, videotapes, and movies. Intangible property other than Section 197 intangibles, including computer software, which is depreciated over 36 months. Any interest in a patent, copyright, or copyright not acquired as a part of a business, and other intangible assets with a limited useful life that cannot be accurately estimated. So the big one, hopefully you caught on to that we're normally going to be placing on line 16 would be if we claim depreciation on computer software. That's where it goes. Part 3, for the MACRS deduction, on line 17, you enter the depreciation deduction you figured for assets placed in service prior to 2012, that should read. And on section B, we're going to enter depreciation amounts for assets placed in service during the year using the general depreciation system. And we went through that earlier, how you enter the basis, the recovery period, the convention, the method, and the final deduction you come up with. In section C, you're going to enter information relating to assets placed in service during the year, which are being depreciated under ADS. Provide information as required for each asset placed in service during the year. The following asset types must be depreciated under ADS, and they include tangible property used predominantly outside of the United States, as well as tax-exempt use property. Imported property covered by an executive order of the President of the United States, and property used predominantly in a farming business and placed in service during any year in which you made an election under IRC Section 236A not to have the uniform capitalization rules apply. So if you're in a farming activity and you do not use the uniform capitalization rules, then you must use ADS. Part 4 is a summary. In Part 4 on line 22, partnerships and S corporations do not make an entry on this line because if you're a partnership or S corporation, your Section 179 deduction is going to carry over to the K1. But for individuals filing Schedule C, you would enter your Section 179 deduction on line 22. Part 5 is for listed property. On line 25, you calculate the Section 179 deduction before calculating any of the special depreciation allowance. On line 26, provide required information. So here's line 25. You enter your Section 179 expense. And then on line 26, you provide required information for listed assets that are used more than 50% in a qualified business activity. And you compare that to line 27, where you enter descriptions and information for any asset that is used 50% or less in a business use activity if that asset is listed property. So that's important when you're in your computer and you're deciding whether or not an asset is more than 50% business use or 50% or less business use. You're making a decision whether it's going to be entered on line 26 or 27, assuming, of course, that it is listed property. And, of course, when you go down to line 27, everything turns straight line on you. Provide required information on line 27 for listed assets used 50% or less in a qualified business. In Section B, information on use of vehicles. For each vehicle identified in Section A, you must complete lines 31 through 36. There is an exception. Employers are not to provide this information for vehicles used by employees who are not more than 5% owners. So we've got this information that is required for each vehicle. It asks you, we've got vehicle 1, vehicle 2, vehicle 3, all the way up to vehicle 6, and you would attach a statement if you have more than that. And then it wants to know the total commuting miles that were driven on that vehicle during the year, the total of all other personal miles that are not commuting miles, and the total miles driven during the year. What was the vehicle available for personal use during off-duty hours? Yes or no. Was the vehicle used primarily by a more than 5% owner or related person? Yes or no. And is another vehicle available for use? Yes or no. Those are all mandatory questions. A pet peeve of mine is when I see a tax return that was professionally prepared and the preparer did not bother to answer any of the questions. And you might be thinking, well, it's so hard to get my clients to give me that information. Well, yes, it is. I almost feel like strangling them sometimes. The number of times I have to repetitively ask year after year, even week after week, for the same basic information can be overwhelming when you're busy and tired. But in a due diligence capacity, it's our job to get that information and not to just kind of wash our hands of it. And we certainly don't want to make up numbers that we don't know are fact. This is a required section, and you basically need to get it out of your client by whatever means necessary. Section C, questions for employers who provide vehicles for use by their employees, and that's this section right here. If you are an employer who provided your employees with a company vehicle, you must complete this section. See page 13 of the instructions for Form 4562 for more. And then finally, we're on the very last part of Form 4562. That's the amortization section. You claim amortization by completing Part 6 of 4562, and assets placed in service at any time during the month are treated as placed in service on the first day of that month. On line 42, you provide the required information and for assets placed in service during the year, and line 43 is used for assets placed in service before the current year. And that is the end of the lecture part, and we still have a good hour in the day to really take a look at some of the assignments that we had to work on today. So I'm going to pull those assignments up, and we're going to spend the rest of today's class working through some numbers and see how you do with those. So the first assignment that I had you work on earlier today was an assignment for Nina Para. And your job at this point now is to fill out the 4562 for her. Do you remember that I asked you to figure out what her depreciation deductions would be? And I gave you that information. I'll put it up here. You were supposed to figure her depreciation schedule, or the numbers that would be on her depreciation schedule. But now I'd like you to take it to the next step and do your best job of completing a 4562 for her. And so I'm going to put up a little note here of what we had figured. So on the rental townhouse, the depreciation that we came up with on that rental is $1,116. And for the washing machine, it was $37. So take a minute to prepare a 4562. And if you haven't printed any 4562s out ahead of time, there's a couple places you can go for that. One is the IRS website. Simply go to irs.gov, type 4562, and print it out. And the other option is to go in the manual to the page I have on Form 4562 and fill it out for Nina Para. Okay, I've loaded the answer key. This answer key, like the other answer keys, is inside Open Campus where you can access it. And our character in this story is named Nina Para, and remember, she had an asset that she placed in service outside of the United States. Therefore, it is ADS property, and her rate of depreciation is 40 years for the townhouse and 12 years for the washer. And we came up with these two depreciation deductions over here. Now, when we fill out her Form 4562, we're going to be completing Section C for assets placed in service during 2012. We're going to show 12-year property, and we're going to show 40-year property. The washer's cost is $899. The half-year convention applies to it, and it's going to be straight line, so we enter $37. We then have 40-year property. It's a mid-month convention, and it's $63,000. And it's also straight line, and we get $1,116 on it. And when we add those amounts up, we have $1,153 of depreciation for the year. So that concludes the review of classwork assignment number 2. Let's now take a look at the next big one in line, the one that will take some more time. For classwork assignment number 3, I'm going to put up part of the classwork answer key for number 3. Actually, what I'll do is we'll review the classwork assignment answer key for 3. We did that together as a group. So now we're ready actually to go on to classwork 4, but I want to find the depreciation schedule and put that up for you because that'll make your job easier. You really need that schedule. There it is. Okay, I cannot show you both schedules at the same time. So it's a choice between showing you the Schedule E depreciation schedule or the business schedule, and I'm going to go for the business schedule since it's got more on it. I'll review it with you. You can see we've got the car, the date placed in service, the cost, the percentage of business use, the Section 179 deduction claimed, the depreciation basis is therefore 0, the life is 5, and basically we're just carrying that deduction all the way across, $1,612. So Because we're claiming a Section 179 deduction on this car, we're going to enter that deduction in Part 5 under listed property. For the office building, we have an asset that costs $250,000. There's a salvage value, which is essentially the land value coming out, leaving with us a depreciable basis of $175,000, 39-year property, straight line, mid-month convention. The rate is $2.564 per month, and the current depreciation deduction is $44.87. It was placed in service in the earlier year, so we actually have an accumulated depreciation amount of $87.87. That's figuring last year plus this year. And then we have the cell phone, $150 multiplied by 45% business use, gives us a basis for depreciation of $68. The life is 7 years. And we then come to $10 as being the depreciation deduction for it. The laptop computer, $2,500, 45% business use, $1,125 is a basis for depreciation. We have to go straight line because it's listed property, use less than 50%. We ultimately end up with a $113 deduction. The desktop computer is going to be deducted under Section 179. It's used in a home office, therefore it's not listed property. It's going to go in Part 1 of 4562. And the desk will also be deducted in Part 1 of 4562. Dwarf. D-W-A-R-F. Dwarf. So let's take a look then at the 4562 for this taxpayer. So taking it one at a time, each asset in turn, the first asset that we come to is on the depreciation schedule is the desktop computer and the desk. So we already discussed how these are eligible for the Section 179 deduction, and because they're not listed property, we're going to be entering those on Part 1, and we total up the cost of those assets. But with those, we also total up the cost of assets that are listed property. And so one of the things you'll notice about 4562, and it's often the case with other forms that I've filled out over the years, is that the best place to start is not necessarily page 1. It can be better to start on page 2 because from page 2 under listed property, you're going to be carrying a number over to line 7. And of course, that's the depreciation deduction for the car. So let's go to page 2 and figure our entries for the listed property first. And here you can see we've got the car. Zoom in on it. On line 24, it asks, do you have evidence to support the business or investment use claimed? That is a question that is asked about 4562. When you are claiming business use of listed property, you're supposed to answer the question, did you keep records to prove that you used it for business, or don't you have those? Because you are required under the law to be able to establish and show what your business use was. For an automobile, that would take the shape of a mileage log or a calendar on which you recorded the appointments and the places that you drove. So if, assuming you did keep those records, you would be able to check line 24A as a yes. And then the next question is the evidence written? Well, it's supposed to be. So if it isn't, you would check no. It's possible you have evidence of business use, but it's not in writing. Maybe a computer, for example. How would you show that a computer is business use? We could certainly go into the hard drive and all of the programs that are on it, and if it's full of video games, then it would be hard to prove it was business use. But if it's full of, I don't know, tax school or tax software, from my perspective, that would be easy to show. Then we move over to the asset that we're going to describe, and on line 26, we're going to enter a description of the asset that was used 50% or more than 50% and was listed property. There was only one asset meeting that description, and that was the car. So we enter the date placed in service, the business use percentage, the original cost basis of that car. We're not claiming any kind of depreciation deduction for the car other than an election under Section 179. So we enter $1,612 under column I. The next asset listed in here is the laptop computer. The laptop computer is 45% business use. We multiply that by the cost, and we get $1,125. It's 5-year property. We apply the half-year convention, and we get $113. We then have a number on line 28 and a number on line 29. 28 is 113. 29 is 1,612. And then it says, add the amounts here, and then enter the result on line 7 of page 1. So now we're ready to go back to page 1, and we're going to enter that number, 1,612, on line 7. We then look at the limit. The limit is $500,000, and how much did we spend on qualifying property for the year? So where did I get $20,792. I bet you're asking that question. So let's see where the number for line 2 came from. On line 2, this is the answer key I'm reading, you're going to enter $20,792, which is the total cost of all listed property in Part 5, plus the cost of property eligible for Section 179 deduction. That's $17,850 for the car, plus $68 for the cell phone, plus $1,125 for the laptop, $800 for the desktop, $450 for the desk. And remember that rental property? We put a fridge in it. We can't Section 179 it because it's in a rental, but it's still the type of property that would qualify if it was in another activity other than rental. So we throw in the $500 for the fridge. And once we've done all of that, we get $20,792. It looks like there's been some rounding going on here, or an error where it's $20,793. But $20,792 is the correct entry. So we then go over to page 1 again of the 4562. That's where we got our number from. $2 million is the most we can spend on property, but we're far less than that at $20,000. We then go over and figure our allowable deduction, $800 plus $450 plus $1,612 totals $2862. Then on line 17, we're going to enter a deduction for MACRS assets placed in service in earlier years, and that's the commercial building. The commercial building has $4,487 of depreciation associated with it, and that's the amount we're entering on line 17. Then on line 19, we enter the depreciation deduction for that cell phone. The basis for depreciation is $68. The recovery period is 7 years. $200 declining balance gives us a $10 deduction. On line 21, we pull over the depreciation deduction for listed property. That was the laptop, $113. And then we total up all of these amounts. We take $2862 plus $4487 plus 10 plus 113, and that equals $7,472. How did you all do? Just tell me whether you did real good or how much you missed. Well, hopefully with repetition, we're going to do a little bit better. Yeah, that is a challenging problem for sure. So let's look at the next depreciation schedule, because we had to do 2 for this assignment, didn't we? We have to do one 4562 for the business, and we have to do one 4562 for the rental property. So let's go over to the rental property next. So here's the 4562 for the rental property. There's no Section 179 deduction for the rental property. We're simply going to go down into Part 3, where we figure our MACRS depreciation deduction. You can see on line 19, B, we've entered the washing machine, $500. The recovery period is 5 years. And it was a washing machine, wasn't it, or was it something else? Can't remember. It was a refrigerator. Sorry about that. On line 19B, we enter the $500 cost of the refrigerator. The recovery period is 5 years. We apply the half-year convention, and we end up with a depreciation deduction of $100. Then on line 19H, we enter the date placed in service, which is the month and year in reverse order of the rental property. The cost basis of the rental property that is eligible for depreciation is $100,000. We're going to take that, divide that by 27.5 years, and then we have to apply the mid-month convention, and we end up with $34.85. On line 22, we add up the two numbers of $100 and $34.85, and we get $3,585. So that's classwork number 3 and 4 finished, and now it's time to move on to classwork number 5 and 6. These are very similar to number 4, so you're probably going to want to take some time to work on it. Why don't we start first by figuring the depreciation deduction for each of the assets? I would like you to take a look at classwork assignment number 5. It involves preparation of a Form 4562 and a depreciation schedule for Perry Polar Bear, who started up a new business during the year. He placed the following assets in service. He will not claim bonus depreciation or a Section 179 deduction for any of these assets. He will not claim a deduction for startup costs and chooses to amortize them instead. Prepare his depreciation schedule and Form 4562. And you can see here we're stating that the business activity is a Schedule C activity. He has freezer cases, business startup costs, a building, 5 parlor dining sets, and a point-of-sale system. In other words, a computer peripheral, we're describing it as. So use the information contained in this depreciation listing to prepare a depreciation schedule and a Form 4562 for Perry Polar Bear, and we will go over the answer key together. And I now have Perry Polar Bear's 4562 and depreciation schedule up on the screen in front of you. Let's take a look at his depreciation schedule first. It's shown up at the top of the page, and you can see that he had a series of assets totaling 5 that he placed in service during the year. The freezer cases, the business startup costs, the building, 5 parlor dining sets, and the point-of-sale system. I look first to the date placed in service on these assets, and I established that there were really no assets placed in service in the last quarter of the year. Certainly, the mid-quarter convention does not apply, and that means we're dealing with the half-year convention where and when it applies. The half-year convention will apply to the freezer cases, the 5 parlor dining set, and the point-of-sale system. But of course, the building will fall under the mid-month convention, and the business startup costs, those are amortized over a period of 15 years. Going across the column, you do see under salvage, we listed the land value of the building just so that we could subtract that out and get a depreciable basis for the building. It's being depreciated over 39.5 years under the straight line method, and the current year depreciation is $3,297. For the freezer cases, the 5 parlor dining set, and the point of sale, 5-year is the life on all of these assets. They are assets that might be considered 7-year property in certain applications, but assets that are used in the preparation and delivery of food in a restaurant or in a food processing business are 5-year property. And so the rate of depreciation on all 3 of those assets is 20%, and the current depreciation for each of those assets is shown under the current depreciation column. The business startup costs, those are amortized over a period of 15 years. And the rate per year for the first year is 6.111, and the first year amortization will be $2,696. Let's zoom in a little here and take a look at his 4562. We can see on the 4562 in Part 3, we're going to list the 5-year property. That's the only category of half-year convention property he has. He had 3 pieces of property, and there's only space in the line to really list a single one. And so we list the total depreciation for all of the property placed in service during the year. And then we go over and show the half-year convention and the basis in each of the assets placed in service on a supporting statement. The supporting statement shows us that the deduction we are claiming is $3,182. And do remember that Perry Polar Bear has elected out of bonus depreciation, which is why we're showing no depreciation for bonus on this particular return. Now moving on to the non-residential real property, that is the commercial building in which the restaurant is housed. That is 39-year property with a depreciable basis of $146,910 and a first-year depreciation of $3,297. With the business startup costs, we list those in Part 6 under amortization. We describe the business startup costs. We show the date that the amortization begins. We show the amortization amount, $44,122, and the section code under which the amortization is being claimed, which is section code 195. Amortization is over 15 years, and the deduction is $2,696. And the next classwork assignment we're going to take a look at is classwork number 6. And for classwork number 6, we're going to assume all the same facts as number 5, except Perry Polar Bear has decided to depreciate all assets straight line rather than using accelerated depreciation. Complete his depreciation schedule in his Form 4562 using the straight line method. And here we have the answer key for classwork assignment number 6. And with classwork number 6, we're dealing with a very similar situation as in number 5. The only difference is that Perry Polar Bear wants to go straight line rather than 200% declining balance. And in terms of the office building and the business startup costs, there's actually no difference because the office building is going straight line and so are the startup costs, whether they're claiming 200% declining balance or not, because those assets are only ever eligible for a straight line. But when it comes to the freezer cases, the 5 parlor dining set, and the point of sale system, all of those 5-year assets are now going to be going straight line with a half-year convention. And so the rate will be 10% of the placed in service cost rather than 20%. The current depreciation on those assets is $622 and $400 and $570. If you add those amounts up, you can see we get $1,592 of first year depreciation. We attach that statement and enter statement number 1 and depreciation deduction $1,592 on line 19B of Perry's 4562. The non-residential real property, the items being entered there or the amounts being entered there are identical. And for the business startup costs, the amount being entered there is also identical. So that concludes the review of the answer key. Let's move on. Oh, I just saw now the question on the 4562. What does that mean? Let me pull that up. That's a very good question. Thank you for asking it. So one of the things that goes on with the 4562 is IRS wants to know what business the 4562 applies to. In the case of Perry Polar Bear, he's filing a Schedule C, and we have completed the 4562 for his Schedule C. So we're telling the IRS that 4562 applies to the very first Schedule C on the tax return. It's possible Perry Polar Bear has another business. And if he did, he could have Schedule C2, and he would have a 4562 that would go to the Schedule C2. Or perhaps he's preparing a rental property 4562. So if he has a 4562 where he's carrying depreciation to Schedule E, then the 4562 would say Schedule E. So that's the reason for the title at the top. If you're a landlord renting farm equipment to a farmer, do you use 150% or 200% declining balance? I would bet it's 150, but I'm not real sure. We'd have to go to the Farmer's Tax Guide. I don't run across many people who rent equipment to farmers. Can't say I have experience with that. I'd have to look it up. But it'll be in the Farmer's Tax Guide, publication 225. I'll go look at it now while I'm waiting, see if I find anything fascinating to tell you. When I'm thinking about it, I know that it says used in a farming activity, so it's telling me it's 150%, even if you're not the farmer. I'm just looking for it. I can instinctually think something and usually be right, but sometimes I'm wrong. Yeah, the definition of 150% declining balance property is all property used in a farming business. So my instinct is yes. But if you wanted to be sure, you could call the IRS tax practitioner hotline and talk to someone over there who's an expert in depreciation and farming. You might even ask for the farming people and see if they come up with a different interpretation. But that would be my interpretation. If they're renting the equipment and they're the owner of the equipment and the business is renting equipment, it could be different. But if you own the land, you don't file Schedule E. You file a special farming schedule, form for farming. And I just don't have experience in what you're asking about, so I can't be more clear. I'm puzzling through it, but I don't really know. What I'm about to do is review the class work assignment number 1. At the very start of today's class, we discussed tangible property versus intangible property and real property versus personal property. And so just to kind of drive home those concepts, I have a fairly simple, straightforward assignment here, classwork assignment number 1. And in it, we give an assortment of assets and ask you to identify whether each asset is tangible personal, real property, or intangible property, and then to indicate whether it's depreciable, amortizable, or not depreciable or amortizable. And so we'll take these one at a time, and your job at this point is to go through and do the best job you can of whether you think each asset is tangible, real, or intangible, and whether you would depreciate it, amortize it, or whether it's not eligible for depreciation or amortization at all. And beginning with the office building is obviously tangible property. It's something you can see and touch. Land is very real. But it's tangible property, and it is also depreciable. But the land that the office building sits on is, of course, not depreciable. So we would say the office building itself is depreciable. Shares of stock. What are shares of stock? Are they tangible or intangible? Oddly enough, they are tangible. They have real value. They're not intangible without a perceived value. Shares of stock in a company have a tradable value, and so we say that those are tangible property, but clearly they are not depreciable. So the answer for shares of stock is tangible but not depreciable. Then we have Series EE or HH bonds. Again, those are tangible property and they're not depreciable. A truck, assuming it's used in your trade or business, is tangible personal property, and it is also depreciable. We then have a rental house. That, again, also is tangible property, but we call it real property. It's real estate, and it is depreciable. The vacant lot is tangible property, but it is not depreciable. The cow is tangible property. It's tangible personal property, and if we have a cow in use in our farming business, then it is also depreciable. A single-use agricultural or horticultural structure is not real property. If it's a single-purpose agricultural or horticultural structure, then it is considered to be tangible personal property. It is eligible for depreciation. It is also eligible for accelerated depreciation and the Section 179 deduction. Goodwill. Goodwill is intangible property, and it is amortizable if you purchased a goodwill as a going concern value from a business. Then we have franchise fees. Those are also intangible, and they are amortizable. Store countertop. That is tangible personal property, and in use in a business, which obviously it would be, it is depreciable. And then finally, startup costs. Those are considered to be intangible, and they are amortizable. So that concludes Depreciation Made Easy from Pacific Northwest Tax School. Thank you very much for participating in our training programs. There is a homework assignment at the back of the manual that you must complete. And there's actually a series of homework assignments, and they'll give you some more opportunities to refresh your mind on some of the concepts that we discussed today, but also give you more opportunities to complete Form 4562 and a depreciation schedule. In the case of the homework assignment, you are graded. You have to achieve a score of 70% or higher. And there is a quiz to test your knowledge after all of that work. So that concludes today's program. Thank you for participating, and I hope to see you again soon. Bye-bye. Puppy, P-U-P-P-Y, puppy.